Think about the last time you visited your local coffee shop. You ordered a drink, tapped your card, or handed over a bill, and went on with your day. It's a simple, rhythmic exchange we all take for granted. But if you stop and look at that money, a strange question starts to form. Why does this specific piece of printed paper, or those digital numbers on a screen, actually have the power to buy anything at all? In reality, a dollar bill has no value on its own. It's not a tool you can use or food you can eat. It relies entirely on two things. There isn't an infinite amount of it, and every person in that coffee shop has total confidence that they can trade it for something else later. To keep that confidence from evaporating, there's a massive, invisible infrastructure managing the flow. Like a city's waterworks, a central facility regulates the pressure and volume of money, pumping it through a maze of pipes to every home and business. The engineers at this central facility have to find a delicate balance. They need to keep the water flowing well enough so that people can find jobs and businesses can grow, but they also have to make sure the pressure doesn't get so high that the pipes burst, which is what we call inflation. This all started with goldsmiths. Centuries ago, people left their heavy gold with them for safekeeping and used paper receipts to prove they owned it. Eventually, people realized it was easier to just trade the receipts themselves. The goldsmiths then noticed that since people rarely came for their gold all at once, they could start lending out receipts for gold they didn't even have. This is still how modern banking works. When a bank gives you a loan today, they don't hand you physical cash from someone else's account. They simply type new numbers into your account. In that moment, they are creating new money, keeping only a tiny fraction of their total deposits in their own vaults. The danger here is that the whole system is built on trust. If that trust breaks and everyone tries to rush to the bank to pull their cash out at the same time, the local reservoir runs dry, the bank collapses, and people's savings disappear. To prevent these disasters, the government created a central bank, the Federal Reserve. It acts as the ultimate overseer of the waterworks. It's not just one big vault. It's a network designed to act as a backup, pumping emergency cash into any bank that's suddenly running out of fluid. But there's a catch. Politicians often want the central bank to print more money to make the economy feel good in the short term, even if it causes a crisis later. In 1951, a historic agreement was reached to keep the bank independent from the president and Congress. This independence is vital. It means the people running the valves can make the difficult, unpopular choices, like tightening the flow of money to fight inflation, without worrying about being fired by a politician who wants to keep the pressure high. In recent years, the way they manage this flow has changed. Instead of keeping money scarce and carefully measuring out every drop, they switched to a strategy of abundance. They now flood the banking system with an enormous supply of extra cash to ensure there is always more than enough to go around. To control this flood, they now pay banks interest just to park that extra cash at the central facility. By changing how much they pay on these parked funds, they create a floor for interest rates across the entire country. This is how a decision in a boardroom reaches you. When a central banker spins the dial to change that floor, the change in pressure ripples through a maze of pipes. This journey from the boardroom to your local bank is what economists call transmission. The first major gauge on this journey is the interest rate banks charge each other for overnight loans. It's the baseline pressure for the whole system. If this rate moves up, the pressure builds, and eventually it becomes more expensive for everyone else to borrow money too. There's also a specialized part of the plumbing called the repo market. Think of it like a high-end pawn shop for banks. They trade their safest assets, like government bonds, for quick overnight cash to keep their internal pipes flowing smoothly for the next day. If the banks suddenly stop trusting each other in this pawn shop, those specific pipes clog. We saw this happen several times recently, causing the price of cash to spike suddenly. If the clog isn't cleared, the whole transmission system can stall. That's why these mechanics are so focused on the plumbing. Turning the master valve in the boardroom is useless if the pipes are blocked, and that pressure never reaches the rest of the economy. As our banks and our money continue to digitize, the system has to move faster than ever. The central bank is constantly having to invent new emergency reservoirs and high-speed pipes to keep the economy from drying up in the middle of a crisis. For example, they've built a new digital highway called FedNow. It allows banks to settle payments instantly at any time of day or night, making sure the fluid in our economy never sits still. They also built international relief pipes. In a crisis, banks in other countries might suddenly run out of US dollars, which can trigger a global panic. These relief pipes allow the Fed to instantly trade dollars to foreign banks for safe assets, stopping the fire before it spreads to our shores. They even manage the waiting bonus, that extra interest people usually expect for locking their money up for years instead of just days. Sometimes the central bank buys up long-term bonds to shrink that bonus. This forces money out of those safe reservoirs and into the stock market to stimulate growth. But these mechanical fixes have human costs. When the central bank pushes money into the stock market to save the system, it often makes the wealthy even richer, while everyday prices continue to rise. This creates a deep sense of unfairness and contributes to growing wealth inequality. Managing the economic waterworks is never just a math problem. Every time the engineers turn a valve to prevent a collapse, they are making a delicate, often painful trade-off between keeping the system alive and the real-world impact on the people inside it. So, the next time the barista hands you your coffee and your card reader beeps approval, take a second to look at that transaction. The instant beep of that card and the fact that the price of your coffee didn't double overnight are only possible because of the colossal, unseen plumbing operating right behind the scenes. From the first handwritten receipts to today's high-speed digital highways, the central bank has evolved into a global engine that manufactures confidence. By keeping the pipes clear and the pressure stable, they ensure the one thing money needs to survive: our collective belief that it's still worth something. We only trust the faucet because the water flows every time we turn it. And in our economy, that water flows because an independent mechanic is always there, quietly balancing the pressure of the world.